Hi, David.
Hi, James.
You don't talk a whole lot about the energy picture in the USA and in the world. And we have left behind the cheap energy era. And we're now in an expensive energy era. And it's led to a great impairment of capital formation. And I think that this is at the bottom of the government and central banks' interventions and manipulations in trying to compensate for our lack of capital formation and growth in industrial economies. And what it really leads to is the question of what is money. And I want to know how you feel about that, and why you don't talk about the energy picture much.
Yeah, well, I mean, there's a couple things on the energy picture. We do comment on it. In the commentary, we don't, in part because it's something that we do quite a bit with Bloomberg. It used to be called Weekly for comments on the energy picture and inventory levels and pricing and what the factors are in driving the price up or down. So we do certainly do some research there. It hasn't factored into our investment thesis, in part because it's highly politicized. I mean, if gold and silver can be badgered or bullied for weeks or months, the energy picture can be changed dramatically for years when OPEC decides to do something different, when Russian foreign policy changes and they decide to do something different. So these are factors that, again, they're risk variables today that make an energy investment less interesting. Now, I say that we have a few things on the horizon for our wealth management program, in working through and working towards an exposure to energy. But again, it'll be different than you might expect.
Well, I'm not suggesting that that people invest in energy per se. What I'm suggesting is that the problems that we face as an advanced technological industrial society with no longer cheap energy are driving the deformations of capital, and that is really what is behind the question of what is money, what has money nests, and what value really is.
Yeah, those are great questions, and I think part of the reason I like them is because they do have a philosophical tone to them. When I look at agricultural commodities, when I look at energy, oil, natural gas, when I look at gold and silver, this is stuff that has it's stuff as opposed to what can be created out of nothing. And again, that's credit and what we associate as money today, Federal Reserve notes. That is not stuff. That is fiction. That is an idea. That is something that we associate with money, but has no real bearing on again, what has been at least enduring as money through the decades, through the millennia. And the deformation of capital, I think, has even more to do with the credit markets and the leverage that has been created, the amount of credit created, the amount of funny money which has been created, than probably the energy picture. And maybe this is something that you and I would have to, again, talk about over a glass of wine and sort of make sure we understand where each of us is coming from.
Yeah, I'm not sure you understand where I'm coming from.
Yeah, that may be the challenge in the question today. Again, looking at sort of different perspectives on what represents the deformation of capital, I'd love to understand that a little bit more from your vantage point.
Okay.
What is money? I think one thing has not changed through 4,000, 5,000 years of recorded history. What is money is something that is scarce, something that retains value, something that represents a store of value, something that is recognized universally as such. And the short list, you end up with gold and silver, and at different points in history, silver's gotten kicked out of bed, and gold's been the only thing left in terms of what is money or meets the criteria of what money is. Can we have that conversation? I'd like to visit with you further on it.
Well, I'm the author of The Long Emergency and many other books, and you can find me on the web.
I recognize your name.
Well, I'm out there.
Okay. Let's have
you are.
Let's have that conversation, both on the deformation of capital and energy, cheap energy being gone. I would agree with you. We are past that era, and there are implications for it. So I look forward to it.
Okay.
Thank you. Hello, David.
Hi.
I would like to ask a very simple question. You mentioned in a recent email that the cost of gold cannot go too far lower, otherwise the gold miners aren't going to make any money on it. At what price does gold have to sink to that level to where it's no longer profitable to mine gold?
Good question, Robert. There's a spectrum because, again, it depends on the quality of assets. It depends on the grade of the ore and how rich or not it happens to be. And, of course, in terms of scale, if a small company has any sort of scalability or benefit from size of operation, you will find a range from 1,500 to 1,800 on the high side. And obviously you're dealing with companies that won't be around very long. Mining gold at 1,500 to 1,800, they're giving it away. It's below their cost of what they're getting for it is well below their cost of production. On average, you come closer to 1,200 to 1,300, and these are sort of what I would call your all-in costs. What you'll often find is that mining companies will advertise a cost of production in the $600 to $800 range, but what they're not including is basically all of their overhead and what it takes to actually run their company. So, what does it take them to get an ounce of gold out? And instead of sort of the 600 to 800 average that you generally see advertised, it's about twice that. It's about twice that. A few rare companies, 900 to 1,000. The vast majority somewhere between 1,100 and 1,300. If you wanted to pick a number just right down the middle, you might say $1,200. $1,200.
Well, we're very close to that right now.
Yeah, and so when you play that out, let's just say we stay here for 2 years. If we stay here for 2 years, most of your miners have expended all of their cash in order to survive. They've gone through their war chest. Rather than growing business, it's just been to make payroll and try to survive what appears to be a drought in the market. And then they too would fail. Now you have no new gold coming into, or a very minimal amount of gold coming into the market.
That creates a great demand.
Well, it just means that price has to go up if you have anything on the demand side. If there's any demand whatsoever. So, the reality is the closer you get to the cost of production, the more you're going to knock out your marginal producers and knock out production which would have otherwise been on the market over the next 2-3 ounces that would have been on the market over the next 2, 3, 4, 5, or 10 years. It ends up pressuring the price higher. That's the final equation.
Well, we're close. We're almost there right now.
And that's a part of the reason why I'm not particularly concerned about where we're at in price and where we're going. I would be far more concerned as an investor about how many ounces I owned, and if I own a sufficient number of ounces, and if I don't, what am I doing to rectify that? Again, on a dollar cost averaging basis, how can I? I think this is one of the things that we should, from a perspective standpoint, look at. We have more time to accumulate. The bottom line is, with this 18, 19 months time out, we saw gold go from 1,100 to 1,900 without really skipping a beat. And it was going to define the life cycle of this bull market as probably a 13 or 14 year bull market. We could have ended this year or next had we not stopped and seen the correction that we're seeing right now. As it is, the result of this kind of a correction is that you can assume 3 to 5 years more of growth, which, if you're still accumulating, is a gift It's absolutely a gift. Whether you're accumulating from current income or from the sale of other assets or a lump sum distribution from a pension, or you have time, and you were almost running out of time in 2011. The pace at which we were accelerating was moving towards an unsustainable pace. 150, 200% rate of change, those are not sustainable numbers. And we were very much moving in that direction. We've slowed down. We've caught our breath. I'm not saying it's been pleasant at all, but what I am saying is that it's a gift. It's a gift. So again, I would look at it as an opportunity to accumulate because you're sitting right on what is.
I've reached my limit. If I buy anything, it's got to be a few ounces of silver, because I have a large dental bill looming ahead, which is going to wipe out my bank account. So, and plus my age, I'm 71. So I have accumulated a certain number of pieces of gold, both in numismatic and bullion, and several ounces, maybe a couple hundred ounces of silver.
Well, Robert, one of the compelling stories today, I think, is silver. I mean, I mentioned earlier that this morning I bought silver. One of the reasons I bought it is because the gold-silver ratio is sitting at 65 to 1. At 65, at 75, at 85, basically anything north of 30, silver is a compelling value. Anything south of 30 on the gold-silver ratio, you're really arguing that silver is really rich. And gold is probably a better value. So what's the better value today? Silver is. I mean, there's no, hands down. I mean, and again, adding to a position, I don't need any more gold and silver. I shouldn't. Arguably, I should not add any more ounces. At these prices, I like it. I'd rather have that than greenbacks. And I answered the question, the very basic question of, if I had a wheelbarrow full of cash or a small box full of gold coins, which would I prefer?
It's a no-brainer. Gold.
It's a no-brainer to me, too. And so anytime I've got cash accumulating, I look at it and I say, what would I rather have? What would I rather have? So as a no-brainer, and looking at the gold-silver ratio, 65 to 1 makes it an easy choice for me at this juncture. At some point, very dispassionately, I'm happy to exchange my silver for gold or exchange my silver for a plot of land or whatever it may be at that future point. But it is a great value. 65 to 1, it's compelling. Thanks, Robert, for your question.
Okay, thank you.
Oh, hi. I'm kind of the thinking that, everything is kind of manipulated with the price, and like the Fed kind of manipulating data, all the unemployment numbers coming out. So my question is, because we have the premise that all the manipulation is going to end, and then one day the price discovery is going to become like free market. And what if the Fed can just manipulate this forever? And what if the population is just so dumbed down that they never do rush into gold and silver. They believe whatever the Fed says. The Fed says that unemployment's getting better. The data comes out, however they have it, and because we're all waiting for the free markets are going to take the prices where they're supposed to be. But what if the Fed says no? Well, the economy is improving, everything's fine, and everybody believes in. Like, what if it just keeps going on and they're like almighty, all powerful? What if they just they get to control this thing forever, and they have other tricks in their bag that they can pull out that we'll never see an end to this. That's my question.
Great, Alex. There's a bunch in there, and that I'd love to respond to. I think the first thing is to say that you do have instances in history where things are controlled, and not only is the PR machine working and working effectively, but means of distribution, means of production, everything is controlled. in every one of those instances, we've ended up with a failed state.
Right.
Probably the most dramatic is Russia, where it didn't matter that they said everything was working and everything was okay. They were failing, and they were failing more and more, and the best they could do was control people's minds and people's behavior to the point where, hopefully there was a positive outcome. Well, there wasn't, and there never will be when the free market is contained. Like I mentioned earlier, we have this week a great example of the Fed losing control, the Fed wanting to manipulate perceptions of stability in the Treasury market, and yet yields are still moving higher. I mean, literally, again, how much time has it taken? It's taken about 8 weeks to go from 1.66, the yield on the 10-year Treasury, to 2.51. 8 weeks. And then we dig into the details and see that they, this week alone, have tried to cover that up and tried to smooth it over and tried to improve the numbers, but to no avail. Even spending close to $55 billion in the market, actively manipulating, they still are not in control. The market is bigger than them. The market will always be bigger than them. And you raised some other good points. I mean, yes, we live with a public that is very dumbed down, and yes, we live with an investment population that will tend to believe what they're told. But I mean, this is just, if you look at our education system, we're not taught to think independently. We're taught how to respond to experts and respond with great faith and confidence. As long as they have a PhD, as long as they have more of an authoritative view than our own, then we must rely on them. And that's a consequence of the dumbing down in our educational system, where we're not taught to be independent thinkers. We're not taught to be independent, autonomous, free agents. We're taught to be sort of cogs in the wheel of life. So there is that problem. The problem will be that there will be lots of people who continue to believe the pablum given to us by government, given to us by the mass media, and the consequences for those people will be grave. Unfortunately, it will be grave. I think this is where, as independent thinkers, you've got to say, well, that's everyone else, or at least those who were unwilling to sort of unplug and think for themselves. This is where, until we are on an official gold standard, which I think is probably the outcome of all of this, if you fast forwarded to a 2025, 2035 time frame, that 10-year period, it wouldn't surprise me at all if the people, we the people, joined by the masses who were abused by the system between here and there, vote for a gold standard. Until we get there, you have to put yourself on your personal gold standard. You have to keep your savings in precious metals. And as Mary Ellen mentioned earlier, it's just her, it's money. It's been a vehicle for savings, and it has kept her ahead of the rate of inflation, and it has adjusted over time sufficiently to preserve her purchasing power. This is the deal. We will either be caught up with the dumbed-down public in something that is ultimately catastrophic. And why do I say this? Because there's never been a fiat system which has ultimately done well. It does well for a time. In fact, if you look at Germany, there were periods in time in that 1919 to 1924 period where the mark doubled in value in a few short weeks. Consider this. When you look at gold price volatility, realize that if you were a German in the context of the hyperinflation, gold could get cut in half. Silver price could get cut in half in a matter of weeks as your currency was doubling in value. On its way to what destination? Irrelevance, the dustbins of history. Zero. And so, I realize your question didn't relate to volatility, but when you're dealing with a fiat system, I think this is really where you've got to step outside of what we're being given in terms of a manipulated set of data and do our own homework, do our own research, do our own thinking, and invest accordingly. Don't let the system take care of you. It simply won't.
Right. Right, because... And another question, who knows what the Fed is doing, behind closed doors? Because they, what if they say, okay, we're going to start tapering, and they don't do it, and they keep buying stuff, behind closed doors. and they're propping up the markets, but they're telling people, okay, we're tapering, we're stopping. And a lot of people think that they can't stop QE,
and that's exactly what I'm addressing in that purchase of $55 billion worth of product this week. They can say what they want about tapering. Even this week, the cause of instability in the global markets, talking about tapering. Meanwhile, what are they doing? This is where you just basically have to turn off the television and turn off the radio and go to the source. Go to the source, and don't assume that they are with great sincerity telling you the truth when they open their mouths. Watch what they're doing, and you can. Federal Reserve statistical release. This is, I'm not saying we've sleuthed out this information in some nefarious way. This is public data. $54.745 billion worth of purchases this week. So I don't care what they say. Just watch what they're doing, and that's where I think anyone who is sort of dependent, reliant on the mainstream media, you have to realize that all of the information you're being given is from a biased perspective. If you can account for that bias, look at the data that they've given, subtract out the bias, you may find some meaningful data, but you may not. So do your own homework. Thanks for the question, Alex.
Okay, thanks.